would look unusual historically. Cost of construction is one of them. Things went suddenly. Whoosh. Rents have done the same. They dropped initially in 2020, and now they've rocketed to record highs. There's lots of things are following that kind of pattern.
Yeah, yeah, it's just very, very unique time in history. Yes.
It is, yeah. I mean, I guess
Mm,
the people who benefited, okay, yeah, there was obviously some scary kind of times there in February and March 2020 when nobody really knew how bad things were going to be. Nobody really knew what the lockdowns were going to do. I think in hindsight, Australia probably overstimulated. The package that was put in place with JobKeeper and
mm,
interest rates at zero to build that bridge across the other side as it transpired, I guess, I suppose you could say better safe than sorry, but we probably delivered too much stimulus, which is obviously easy to say in hindsight. But I suppose it's better than not doing enough. Yeah, the cost, of course, was we got inflation and as a result, higher mortgage rates. But it looks like we're just starting to come back down the other side now. And in fact,
mm.
if you look 12 months out, 15 months out, would probably be a fair bit lower for mortgage rates. So you might be paying 6.5% today or thereabouts, but it could easily be 5 or 5.5 a year from now.
Mm. Yeah, well, yes, is all like I said, probably almost overstimulated. And but one good thing is for people who have houses, have a real estate, have a massive boom on the net assets,
Yeah, I
30,
mean,
40, 50, 70%.
yeah, completely. Yeah, and
Mm,
I think even though that's happened, what we haven't had is the big supply response. So,
mm,
in a sort of other things being equal, if the price of housing went up 50%, you'd expect to see people building all over the place. But actually, it hasn't happened for a number of reasons. Interest rates is one of them,
mm,
but also the cost of construction is probably up 50%. If you're trying to develop say a townhouse or a unit project, it's 50% more expensive. Um, we've seen a lot of developers go broke, go
mm,
insolvent because they were operating on pretty thin margins and fixed rate contracts, and a lot of them have gone to the wall, record insolvencies last year. So I think if you even now, despite the big increase in prices, well, if you look at we had some building approvals figures out this week for the month of March, about 15,000. Well, the government's target, if you remember, is 1.2 million homes in 5 years. So if you strip that down, that's 20,000 a month basically. But we're running
mm,
at about 15 or 16. So I guess look, it's still fairly early days. I guess you could argue. But in the first 9 months of the financial year, we've approved about 135,000 dwellings, but that's way short. The target's
mm,
180, we're like 23% under. So,
mm.
yeah, even despite the big increase in prices, it just hasn't translated to a supply response yet. I do think, though, we might be near the bottom now for the housing construction cycle. And if we're having this conversation 12, 24 months, you'll start to see those approvals picking up. But it just takes time. I
Mm.
think a house you can deliver in, 9 months, say, but a townhouse project or a duplex or a block of units might take 2 or 3 years to actually get completed,
Mm.
especially if there's site remediation and approvals processes. So we will get a supply response, but I dare say it's probably 2 or 3 years away before we really start seeing that move the needle.
Yeah, yeah. Let's actually it's a fix. Well, it's a future fix for the current problem. Does not address the current pressure. Does not release the current pressure at all.
No, and in fact, we're coming
Mm.
from quite a low starting point as well.
Mm.
We're a long way behind. Shane Oliver does a nice graph from AMP about the sort of
Mm.
undersupply, oversupply, and yeah, we're a long, long way undersupplied at the moment. I think, yeah, other things that have been interesting in recent weeks. I mean, I guess the sort of the Trump election win. I mean, it's such an unpredictable administration, but one of his policies was to drill, baby, drill, and get the
It's
get
a
the oil
famous one.
price down. Yeah, but
Mm.
I guess there was always that potential that with conflicts in the Middle East and elsewhere that the oil price could go up. But actually, as of yesterday, I think the crude oil price was $56. That's the lowest we've seen in 4 full years. So I guess just driving around on the Gold Coast this week, yeah, I mean, just starting to see fuel prices in the 150s is really good. Like, if you think back to the
wow.
peak of the cycle was $2.12 back in 2022 when the COVID inflation was in full swing. So, I mean, that's a massive win for the RBA and for the government because the cost of fuel coming down probably has the single biggest influence on consumers' inflation expectations. Because when you're driving around, it's like the biggest number you see, isn't it? It's the first thing you see. But also the cost of, the price of oil feeds its way through the global economy, through everything,
Yeah,
manufacturing,
very much.
travel, transport. So, yeah, I mean, hopefully, it might take a bit of time for that to flow through the full fuel cycle, but we should start to see the lowest petrol prices in years as well. So that's, I think the inflation genie was back in the bottle anyway, but that will really cement the victory, I think.
I hope it gets quicker.
Yeah, yeah.
It gets done
I think
quicker. Mm.
we've got a very unusual thing in Australia where we have the fuel cycle, and you have, it just doesn't exist in Europe. You just go to the servo there, but here, it's like, well, go in on a Wednesday and you'll get your different prices. But so it will take time after Easter to flow through. But I think you'll start to see fuel prices at 150 and thereabouts in the weeks ahead, and hopefully even lower. So, that all starts to take impact on the inflation figures in June. By which time, I think, I think central banks will be much less bothered about inflation and much more bothered about
Recession.
stimulating the economy. Yeah,
Yeah.
exactly.
Good. So overall, it's still a very positive sign, really. It's no sign you're going to see the property market going backwards. It's still kind of theme ahead.
I mean, I think for the first time in quite a long time, like the indicators all look really positive for housing. I think I think it's true to say that a lot of households are still struggling with mortgage rates where they are. I think particularly the cohorts. I was looking at the couple of the major banks released their quarterly figures this week, and it's true to say that people who borrowed around 2021, 22, there's still quite a few mortgage delinquencies there, sort of 30-day arrears and so on. But actually, if you look at the fixed rate cliff, it's now basically finished. Like so, the fixed rate expiry profile is back to normal. So, I think if you'd have asked me a couple of years ago, I would have thought that the interest rate hikes would have had much more impact on the housing market than they have. I think some markets have just carried on regardless. If you look at Adelaide and Perth, they've they've taken the full brunt of interest rate hikes really in their stride. But even in the other markets, if you look at Brisbane, Melbourne, Sydney, yeah, there's been some sort of slowdowns in some parts and some regional markets, but overall things have held up remarkably well. That sucked a lot of spending out of other parts of the economy, and I think if interest rates go down a few times, then it brings back confidence over the next year. But it might just take a bit of time to get going because. Yeah, if you're still paying around 6%, it's still quite a lot of the repayments are still quite high for a lot of households.
Yeah, but that's really minority, right? It's not a majority. It's small numbers.
Yeah, that's right. I think so the Westpac reported this week and NAB. So some borrowers went into hardship arrangements. So that was something that COVID sort of triggered, I suppose. But if you look at 30-day arrears, they've kind of stabilized for NAB and they're actually on the way back down for Westpac. So I think, there's always going to be some households who get into strife. That's just the way, it's just the nature of it. But I think that the numbers they're not getting worse anymore.
It's actually making me think. Made me think. You see, in that time, there was a government stimulus, like say you for single parents or something, you can only pay 2% deposit to buy a house.
Yeah.
Well, for me, look, I don't know. that's high, really high risk, right? If you don't have any buffer, you put every single dollar in, where you're single income on the lower rates. Well, let's risk very high. It's a very high chance of getting into trouble. The interest go
Yeah.
up, you don't have buffer, you lost your job, it take a few weeks, a month for you to find a job, you will in trouble. I think that's probably one contributing factor to the
Yeah, I
rate,
mean,
I think.
I think obviously being European, I've got a bit of
Mm,
experience of this, and I think at least a big part of that risk is just behavioural. I think
mm,
if you go back to Europe pre 2007 and you could just walk into a bank and say, I'll have a 100% mortgage, it's not necessarily the amount of the borrowing that's the problem. It's just that the borrower has no track record, zero track record of saving any money. And
mm,
therefore, almost by definition, you're taking on a few more unknown risks. If somebody has shown the savings record to save, well, even a 2% deposit, but if somebody saved 10%, you can see they've got some discipline and a bit of a track record of being able to save the
mm,
equivalent amount of money. That is one of the risks, I suppose, around introducing these schemes where you can put down 2 and 5% deposits and people get a gift from parents. And yeah, I mean, it doesn't mean that every borrower is risky, but there'll be some for sure, because what it's like in the modern era. Big tech firms are very good at finding ways to sell you things,
mm.
and the algorithms are pretty accurate and track you down with adverts. So yeah, it's a risk, and it's kind of a bit of a paradox because the regulators got the biggest lending assessment buffer we've ever had, but at the same time, the government's introducing low deposit schemes and other things which completely pull in the other direction. And as you said, financial innovation around mortgages is happening, and other government and bank policies to treat graduates differently in terms of their help debt. And so, yeah, it's a strange dichotomy because you've got, two different uh, sort of groups pulling in different directions. But I would like to think at some point the lending assessment buffer just goes back to normal because now it's just shutting out the low income earners. And I just I don't see what value is being added now.
Yeah, that's right. That's right. And also the higher assessment, well, higher buffer rate is actually lots of people with their current plan. You can't move.
Mm.
Yeah,
Yeah, I
there's
think you
actually
can refinance now with a lower buffer. So at least that.
let's only few banks. There's lots of restriction on that as
Mm,
well. Lots
true.
of restriction. It's not like It's actually in the principle it reduce the competition.
Yeah. I
Mm,
just went through a refinancing myself over
mm,
past maybe a 6 week process. I almost lost the will to live by the end in terms of the amount of paperwork and statements and
mm,
stat decks and legal this, that, and the other. It's like I don't know what risks we're trying to reduce sometimes. I think tight lending standards and good regulation, yeah, up to a point, but it becomes a bit self-defeating after a while if you're just making it too hard for people to actually get through the process. I mean, yeah, for sure, if you're just a salary income earner and you've got two pay slips for a couple and it's that's easy, but there's so many people who are self-employed or business owners, and well, because you're in the industry, like sometimes it's like, yeah, you feel like what risks are we trying to manage? It's nowhere near as bad as it was in the Banking Royal Commission when you had to
mm.
provide. Oh my God, yeah, let's not go there. That was a painful time.
Yeah, yes. Look, it's all well. Most of that things that compliance. The bank try to cover themselves as well to show the regulator they are doing their due diligence to assess the borrower. They can manage the potential risk. But again, it has to come at a level. You can't stop the money flows.
Hmm. No, I mean, I think
Mm,
yes, I think um, yeah, I can see where these things go. Like they start as a really good idea, trying to reduce risk in the lending market, but you don't want to try and reduce it to zero. That's the thing. I think you can have too much of a good thing, and arguably even the Great Recession in the US was caused by a housing shortage. And that there's even books been written on the subject. It became you ended up with not enough housing. And Australia's at risk of doing the same thing now. Different drivers, but we've had high population growth, and it's very hard to get money to do a development. So I've got no end of clients who, they want to do townhouse projects or build a duplex or build a home, but when they go through the financing process, it's just it's just too hard for so many people to access funds, so they just don't bother. And then so you get inelastic supply. It's not actually healthy. And plus, we've got first home buyers completely shut out because they just can't borrow because they're being stress tested at 9.5% mortgage rates. They're never going to pay, and they just think, well, okay, I'll just rent instead, and that sucks too.
Yeah, and also baby boomers worry about selling their house and lose their pension. They don't want to sell either, so we'll start.
No, yeah. So I think, hopefully interest rates will normalise. But I'd like to think as well that lending standards just ease up a bit. We've taken interest only lending down from 43% of the loan stock down to about what are we now, 12 or something. It's like, okay, I mean, I agree that was a risk or a systemic risk that needed to be addressed, but now we've gone so far the other way that there's not enough rental stock. A lot of investors have bailed, and I guess you just need to strike that healthy balance, ideally.
Yes, it is. It is. You want a horse to run faster, but you tie that it fits.
Yeah, completely. So anyway, I got off subject. Yeah,
They fix legs.
yeah, but I think it's wrapping up. I think most likely, we've definitely got a shortage of housing that's going to continue for the next 2 or 3 years. Interest rates, like I wouldn't bank on them going low, but they're certainly heading downwards trajectory. The economy's held up pretty well, and obviously there's a big stimulus coming down the pipeline from the government. So there's quite a few sort of tailwinds there.
Yeah, great. Well, I think the main thing is if you want to buy, just buy. Don't hold back. Probably the lower end of the market probably have another boom again, because of this stimulate and migration. But who knows? Based on past experiences, people who bought a decent house in a good location haven't lost anything at all. On the country have gained a lot.
I think, I think that's probably fair to say that. But I think a lot of policies over the last 25 years have really undersupplied the bottom end of the market. I think the government used to supply social and affordable housing, and they've, except for a very brief period during the Rudd government, that just doesn't happen now. So it's created this kind of crush load effect in the bottom quintile or quartile of the market, where there's a lot of renters who want to buy. There isn't affordable rentals for people on that end of the market. Now we've got 5% deposits coming. So I think generally speaking, higher mortgage rates do have that tendency to push more people into the lower price points. I think that's where things are going to be really crush loaded over the next, certainly through 2026. Maybe if interest rates come down, then people's borrowing capacities send them up into different price points. But I would say my guess is that that cheaper end of the market is going to be very, very busy over the next couple of years.
Yeah, great. I think let's also the market where investors are quite active as well.
Yeah, completely, because rental yields tend to be higher down there as well. So and that's why markets like Townsville and Darwin and all those kind of areas are seeing so much activity, and increasingly out of suburban Melbourne. Same reason, because you can get in at relatively good price entry points, and I think it's that tends to attract investors when there's a good rental yield or rental return.
Yeah, exactly. Now it's time. If you want to buy, do not procrastinate. It's not a time to hold back. If you want to buy, you do due diligence. Go ahead.
Yeah, and speak to a good mortgage broker, as you should say.
Oh yes, of course. Thank you. And I use pricing as well.
I think it's an important point because I think I look back to when I first bought property. I really had no idea what I was doing. I was very lucky to have a good broker on my side to explain how principal and interest worked and interest only worked, and yeah, the landscape is changing almost by the week. So you definitely want to get a good broker on your side. So give Eric a call.
No, thank you for saying that. Okay, great. So I think we're pretty much close to 1 hour now. We haven't got much question here. Thanks everyone joining in. We'll do regular Facebook Live. If you have any questions, please drop a message. Peter and me will be very happy to answer. And also, if you wanted to discuss any particular topic, just give me a message. We will try to arrange it. Okay, good night and thanks everyone.
Thanks, Eric. And yeah, great to be on, everyone. And yeah, if you want to drop me a note, petewargin.com or Pete Wargin Blogspot is my daily blog, or you can get me on Twitter or practically anywhere online. You'll find me easy enough.
All right, thanks everyone.
Cheers. Thank you.